Earnings are very good, and I would argue unambiguously good, not just about the past quarter, but also, what they're telling us basically about future earnings. But I think it's important to keep in mind, number one, that we've been sort of, in a pullback since the first week of February, the 2nd of February, to be very precise. And so you have to put it first in that context. Positioning was a big issue, as we argued at the time. And so, we were in a pullback mode. And then the question is, we got these great earnings. Why hasn't the market? Why hasn't that really helped the market? And I would argue, again, number of issues, but predominant among them is a concern among investors that, we are very late in the cycle. This is peak earnings. There's cost pressure, so margins are going to go down, and so we have these great earnings, but they're helped basically by the tax cut, by the depreciation in the dollar, which is going the other way. Rates are going higher. So the list is very long.
So in general, the equities are not reflecting the current oil price. And again, as we were talking earlier, it's oil price today plus the curve, which is certainly reflecting the curve. The strip is reflecting a lower oil price than today. But the equities are not reflecting that. And I think that the market's looking for more stability in the current environment. And is oil going to continue at this level or not? Are these companies going to generate cash flow and returns? As Daryl says, they've moved into a new phase. So we're very much in a transition period right now. And so either oil prices are going to hold and the equities should come up, or oil prices will go down and reflect where the equities are.
A structural force that should weigh down on the dollar. You have Trump, who wants a weaker dollar to help the U.S. trade position. And then on top of that, the market knows that the Fed's going to hike rates. But the market has yet to fully price in the fact that other central banks are going to start to tighten policy. And it's only a matter of time before they do that. And so all of these forces will weigh down on the dollar, and so as a result, we think the dollar will fall over the summer, if not longer, for the coming year or so. Well, the first hike we'd look for in the middle of next year. The market currently is pricing the first hike towards the end of next year. But the main point here is, the timing could be off by 3 months or so, but the direction is very clear that they are in the midst of a tightening phase. And you have to remember, the dollar did particularly well when the Fed announced its taper move 3 or 4 years ago, and then did its first hike. It did much less well when it's been in the middle of its hiking cycle. So the initial stages of tightening are where interest rates have a much bigger impact on FX markets.